The global pandemic created a year like no other, with the impact to financial markets likely to remain well into 2021. This year has tested fund managers. I'm happy to welcome Adele Grace, Head of Funds Data Management at Refinitiv. Adele, what measures are fund management firms taking to remain resilient?
Hi, Thomas. So I think there's a couple of different ways of looking at resilience. There's having the ability simply to carry on operating, to be able to do your day-to-day job. And then there's also how do you find those investments which are more resilient, which provide the better performance. On the first part, on looking at just the ability to operate, I think the financial markets as a whole have shown remarkable resilience. There was very little disruption and almost overnight moving to remote working for thousands of people across the industry. I think that's testimony to the business continuity plans that companies have in place and their ability to adapt and evolve them. I think it's also due in no small part to just how globalized and digital the financial markets already are. So lots of people already had tools in place that they needed. They're already very familiar with things like Zoom calls and MS Team calls and working from home on occasion or working remotely. I do think that companies will look to learn the lessons of 2020 though. They'll look for ways to bring in more flexibility into their business models and of course, keep a continued focus on cybersecurity, on technology and on governance. And then when it comes to portfolio performance and delivering alpha, we definitely saw that the best performing fund managers were those that remained pragmatic and prudent. So not surprisingly, we saw a move to more liquid assets with moves to money markets and moves to large cap passive equity.
How can companies like Refinitiv and LSEG business support fund managers maintain resilient portfolio performance in volatile markets like we have seen over the past year?
So I think the really key thing with resilient portfolio performance is to have a robust investment process, to stick to it, to be objective and to be pragmatic. Obviously data is absolutely central to that. Here at Refinitiv, now a London Stock Exchange group, we have over 150 years of experience providing data and transparency to the world's financial markets. We can really help in that investment decision process with the incredible breadth, depth and quality of data that we provide, and with the ability to navigate across that data and link it together. So you can look at data at a macro level, at the trends and the themes, or you can really drill down into the details and analyze that data in a multitude of different ways. We also provide research of models. So our StarMind team recently published a really interesting study on predicting the resilience of companies through a financial crisis and its subsequent recovery. They identified several fundamental factors which show great promise in predicting change in profitability through a financial crisis. And indeed, the model that they developed was successful in predicting profitable, non-defaulting companies, although it did come at the expense of some additional return compared to their combined alpha model.
Has the incorporation of ESG into investment strategies improved the resilience of fund performance?
So 2020 saw record net inflows into ESG funds, and their performance certainly demonstrated the resilience of ESG. Like there are a couple of fundamentally important factors when it comes to ESG and resilience. The first is that by incorporating ESG into the investment strategy, investors can help avoid those companies that don't have resilient business models. So as an example, as we move into a lower carbon economy, investors are going to want to be able to identify which companies are less carbon intensive compared to their peers in the same sector. They're also going to want to know which companies have plans to reduce their carbon. The second important factor is the social license to operate. There are real risks for companies that don't reflect the values of the society within which they operate. A really good example of that is last year with the online retailer Boohoo, which saw its value slashed when it was accused of poor labor practices. Investors and consumers have expectations when it comes to things like labor practices, equality, diversity, and they expect companies to meet those expectations. So by incorporating ESG into investment strategy, investors can help avoid those unnecessary risks, which in turn improves the resilience of performance.
Thanks very much, Adele, for this highly interesting discussion.
Thank you very much, Thomas.